I am so excited that Natalie Molina Nino is here. Natalie, can you come up? And we're going to move over here. Can I grab a couple of those mics back? And then we'll maybe give you one back for Q&A. It's off? Okay, thank you.
Chopped all the hair off. That'll throw you off.
I am so excited that you are here.
Thank you. I'm excited to be here.
Now our investor perspective. So I'm going to tell you about Natalie quickly, and then I'm going to pepper her with some questions, and I'm sure you all will have some great questions for her. So Natalie came from New York to see us today. Thank you so much.
My first time in Charlottesville.
We really appreciate it.
And I took the really long way here along Main Street, and I fell in love. It's beautiful. Yeah.
Well, we would love to have you back. And I'm sure there's plenty of entrepreneurs here as well that would love to meet with you again. We can take care of that.
This is like an Olympic sport, making these people pitch in 4 minutes. Tracy, dear God.
Yeah. All right. Sorry, you guys.
They're like measuring their rehearsals in
so
seconds.
Much excitement.
They're like, it's impressive.
Yeah. All right. So let me tell you a little bit about Natalie, because she's got an incredible background. So Natalie is the president and CEO founder of Known, which is an impact-driven outsourced CIO firm with clients like Microsoft. She's an impact investor focused on making catalytic impact for women in the world and has done an amazing job. She's a technologist and a coder, and she is a consummate entrepreneur. She has her own exits to talk about, but today we really want to, even though we want to hear so much from her, we want to hear about her investment perspective. She co-founded Builder Capitalist Movement, which is an alternative asset class, and that is taking off, and she'll tell us a little bit about that. She was named one of People magazine's most powerful Latinas. She's worked with Disney, as I said, Microsoft, MTV, brands that you've probably not heard of before. Launched a $100 million operation in more than 30 countries with Lionbridge. And she's the author of a fantastic book called Leapfrog, and it is a new revolution for women entrepreneurs. She learned her first tech startup at the age of 20. So a true entrepreneur.
Not 16.
I didn't launch a
like
tech
Rebecca.
startup. But Natalie, I got to tell a little bit more. She's also worked with Bill and Melinda Gates Foundation, World Affairs Council, Seattle International Film Festival, the Athena Leadership Program at Bernard College. There's just incredible resume. So we're so grateful to have you here. Now I'm going to ask you a few questions. And I'm supposed to hit my timer. Maybe somebody else is going to. Tracy, you can wave at me, okay? Yeah, because I can be long-winded. Okay, you got me? Okay, great. All right. So, I'm a social and environmental impact investor. Okay. You are an impact investor.
And a lapsed environmental engineer that never worked in my field. Because the .com got in the way.
Well, and you had this phenomenal business that you invested in called Tomboy X. Yes. Can you tell us the story of how you met that entrepreneur, how you made that connection, and what made you decide to move forward with that business?
Sure. So this is, I consider myself today a recovering tech entrepreneur, and clearly a masochist because I went into finance. But prior to retiring from tech, my very first .com was in Boulder, Colorado. Funny enough, my friend who lives here was telling me that the same architect designed their Main Street as the one here. Yeah, it looked very familiar. And so Boulder just always felt like a place where I had roots. I had attempted to finish graduate school there. And I had my first exit in a company that I founded in Boulder. And so there was just, always any excuse to kind of go back. And a group of women that I met started an incubator called Merge Lane. I don't even know if it exists anymore. But it focused on women entrepreneurs in multiple industries. And I was asked to come back to Boulder and be a mentor. And they did kind of a speed dating, speed mentoring thing, like a lot of incubators do. I spent a couple of days with this cohort of amazing entrepreneurs. And at the end of it, they were asked to stack rank their favorite mentors. And we, the mentors, were asked to stack rank our favorite startups.
That's a really cool way to speed date.
And I'm a tech entrepreneur who was clearly trying to escape. But there were plenty of tech startups I could have picked, but there was something about this couple. They were a couple that were starting this company. It was definitely at the stage of, the proverbial throw spaghetti on the wall and see what sticks. Like, it was clear they were going to pivot. They were trying a lot of different things, but they were really passionate and they had eccentric backgrounds and they felt like the kind of people who would just figure it out. And so for all sorts of reasons, and maybe also because I felt like I had added some value to them, even though it seemed rather far from my experience, there was just something there that was a little bit magical and it worked. And I stack ranked them as first. And then when they unveiled, everybody's different rankings, they had stack ranked me first. So I was their choice, they were mine. And then we stuck together for about 6 months working with them, advising them.
What's the business? What did they do?
It is, I don't know if they would call this now, but at the time it was androgynous underwear, some other kind of fashion, like for women who love wearing shirts that are built like men's shirts. Mm-hmm. They always pop open right at the boob. It's like forever. So they had created this, shirt that had an extra button there. And so again, spaghetti on the wall, right?
But innovation for females,
so,
right?
Totally.
Solving a big problem.
But, I don't have a background in fashion. I will say my family are immigrants from South America, Colombia, and Ecuador. And the first family member to move here was my grandmother, who made her way as a seamstress in the sweatshops of Los Angeles. So even though I, in my career, had no background in manufacturing or fashion, there was that ancient history in my family that maybe kind of struck a chord too. But look, at the end of the day, they stopped doing the shirts. They did away with a whole bunch of different products. They ended up doing just the underwear. They found the form factor and the couple SKUs that just really hit product market fit, and they ended up doing quite well. I don't want to get ahead of it, but that's why we chose each other.
Give us the punchline. Like, how well did they do? And then back up, and how well did you do as the investor? And then back up to the journey and your experience in that journey.
Yeah, I mean, it was clear that they were pre-pivot. They were figuring things out. But they kind of understood their audience better than anyone that I had met in that incubator. And so we really sort of leaned on that. It's like, well, what does your audience want? And then they also were open to partnerships, which I also thought was a really good sign. They ended up working with an ad agency whose name escapes me now. They were headquartered out of Boulder, and they work now with huge companies like Microsoft. At the time, they were a little bit smaller, and they were a little bit more agile and interesting and experimenting, and they had decided to build a program where they would do free PR and marketing for a startup in exchange for equity. It was just their way of diversifying their revenue streams, right? Rather than paying for, exchanging dollars for hours, they were trying to build a little startup portfolio. And these founders decided that it was worth it for them to do that. Even I was skeptical. I was like, you're going to give equity to an ad agency? I don't know. But the ad agency really took an interest in them and kind of brought them into the fold, put way more energy and time and love into them than I think that they would have even if they had been paying.
And for a business like that is really important to get out there, to get the word out, to let people know that you have this unique solution in a crowded market with a lot of established brands. And
they ended up building this brand called Tomboy X that built kind of a cult following. If you're not part of the cult, you've probably never heard of them, but if you are, you're probably wearing them right now. Like, it's just, it's really interesting how that partnership ended up building a brand that was quite valuable, that was able to pivot easily. And anyway, the long story short is, they had an exit. They sold to a private equity company in the UK called, I think, Craftery. And they retained a significant amount of ownership. So I think they sold about 60% of the company, but they didn't leave, they stayed. And then, once they saw that the company was in good hands, that the partnership with the UK private equity firm was solid, they to this day say that, unlike most private equity exits, this one's a happy story. They found a good partner in this group. they realized that they wanted to retire. And so they ended up hiring from within somebody who had been in the company for a very long time, made her CEO, and then the two founders retired and decided to focus on living their best lives.
So this question is going to pivot into my next one, which is, how long had it been since you met them at that networking event until they reached their exit?
Gosh, I hadn't thought about time span, but I guess, let's see, it would have been 2011 or 12 when I met them. It was right when I started teaching. It was right when I retired from tech and started teaching at Columbia. And I was doing research on incubators, which is how I stumbled upon this one in Boulder. And then they exited pre-pandemic, probably, I'm going to say 2018-ish.
Okay, so it's been a decent amount of time.
Yeah.
So tell us about Builder Capital, because I think you've maybe coined this phrase and started this movement.
Yep.
And then if you could move us from there into your current business.
Sure.
Yeah.
And I'll say, I mean, maybe this also speaks to the tomboy community too, is that Tomboy X community, is that as I started to evolve in my career as an investor, as a founder, I always did a little bit of angel investing, largely because that was the only thing I had access to. Now I'm a professional investor. I manage endowments and large family offices. So I now have a lot more tools in my investing toolbox and bigger numbers that I have access to, but I still retain the angel bucket.
Why?
Because it's fun.
Yes,
because
right.
I don't have to consult anyone.
We joke that we only do this for money, but we also do this because it really is fun.
Because I'm a tech entrepreneur and I can go and up and invest in some underwear company just cause, you know? I mean, I don't have to answer to anyone. There's something sort of beautiful and free about the angel bucket, even though I have less and less time for it. But I'll give you other examples. Like I've invested in the company that's taking the birth control pill over the counter for the first time in history in the US and Canada, Japan, Australia, all the places where sadly it's not over the counter yet, even though in most countries in the world it is. I've invested in, and I'm on the board of Hanky Panky, the lingerie company that also 47-year, I don't know why lingerie companies. That I happen to know the founders in that case. They're actually the final chapter in my book as alternative exits because they did an ESOP and handed the ownership over to the companies. So I'm also, when I think about angel investing, I also think about it's my sandbox to play and experiment with new models and think about things in a new and different way, which is what brought me to Builder Capitalism. And so when I think about the friends who joined me in the investment for Tomboy X, they were all of the same philosophy as me. They had all been subjected in one way or another to venture capital and had not loved the experience. They tended not to be people who wanted to flip companies. There is nothing wrong with building a company for a quick exit, if that is your strategy. And also if the business model lends itself to that. Taking the birth control pill over the counter, let me tell you right now, not a quick strategy. I'm still working on that one, and it's been years. But it's a pharmaceutical company. No one expected it to be a quick turn company, right? There are simply some companies, and also there are some founders and some investors like me, like the group that, for example, joined me in the Tomboy X adventure, who are more interested in building things that last, in building a company that might be here in 50 years. That might not be what you're doing with a company or with a business model, but if it is, there's a different kind of capital that is better suited for those long view type of investments and those long view type of ambitions. And so what this whole group of us decided is that in the marketplace of ideas, I remember I had a nephew tell me he wanted to be a venture capitalist, and I was like, there are other options. But we don't present that to the world. We have, Shark Tank, and we have Y Combinator, and we have all these, Entrepreneur Magazine and Wired, and they present one narrative and one kind of capital, and they don't talk to you about lines of credit. They don't talk to you about different types of debt. They don't talk to you about revenue-based financing and royalty-based financing. There's so many different types of capital, and I decided with this group of friends that we needed to enter the marketplace of ideas with a different concept, and that's the idea of long view investing in companies that still can grow and can still be massive, but you're really putting in capital with the idea that you're building something that lasts, not trying to flip something like you're flipping houses.
Yeah, yeah. Isn't this amazing, right? When I read your bio, and thank you, Tracy, for having such great friends, I was like, oh my gosh, this is that diversity in capital. You've lived the diversity in capital, and also very grateful for your work with women and with underrepresented and underserviced markets, right? Because not everybody has those connections that can initially get in and find those early investors. So we really care about that as well.
Yep.
But just the diversity of what can happen, right? It isn't angel investing right to VC and it's going to happen quickly. And goodness knows, those of us investors who've been at this for more than 10 years and went through the pandemic know that these exits are not happening quickly if the pandemic had anything to say about it.
Or even questioning the idea of an exit, right?
Right.
For 100 years, Goldman Sachs was a privately held corporation. And let me tell you, the people who owned a little piece of Goldman for that 100 years were not hurting for an exit.
Right.
They were happily walking all the way to the bank every quarter with their dividend checks.
Excellent point.
With a company that had no exit for 100 years. So I do want to underscore that there are alternatives to exits.
Mm-hmm.
That if what you want is liquidity, there are different ways to achieve liquidity.
Yeah. So I have one more question for you, and then we want to pass the mic so you all can ask your questions. But this last one, I am asked often, why did you decide to do angel investing? Why don't you just put your money in the market, right? Or take safer options? What is your answer if someone asks you that question?
Well, as now an advisor to family offices and endowments, anyone who is telling you that it's one or the other is irresponsible, and you shouldn't listen to them, because it's both. It's got to be both. Anybody who is putting money into startups is putting 5, 10, if you're the Harvard endowment for some reason, 40%, I don't understand that, but 5 to 10% of your portfolio is in this fun category of startups, alternatives, private equity, no more than that. And you're putting it in with the understanding that, high risk, high reward, but you are not putting, you are not mortgaging grandma's house with that money, right? And so it's really got to be both. And you've got to see what percentage works for you. We know of a family, not yet a client of ours, where the patriarch of the family, who is effectively the chief investment officer for the family, something that I would never recommend anyone do, nor would we do it if they became our client, but his choice is to take all the family assets, and his portfolio distribution is like 50% cash, 50% startups.
Wow.
Bless him. And he can do that with his own money, but even then you'll see, it's clearly not all startups, but so very conservative with the 50%, and obviously very, very high risk tolerant with the other. So I wouldn't say that that's one end of the spectrum, but I would say that split, whatever the split is for you, it's going to be different by individual and by family, but it's both. It's always got to be both.
Yeah.
Right?
That reminds me of, going to Atlantic City and having $100 and leaving 50 in my pocket and playing with the other 50, and I was not going to touch that 50. Right?
Were you successful?
No.
You got to leave that 50 in the room.
Right. All right. We got some mics. Any questions from the audience? If you don't mind, please raise your hands so we can capture your question.
I met you, Karen, earlier.
So over the last few years, there's been a lot more emphasis on investing in women-owned or women-led companies. And I'd like to get your view on that, and especially with respect to the fact that the numbers are going down. It's not getting better.
Yeah.
And, is it supply, is it demand, is it lack of confidence, is it the historical bias? What's going on?
Well, it isn't demand, and I'll give you the stats around that. If you are investing in entrepreneurs, by the numbers, that means predominantly women of color. Because today, women are starting businesses at twice the rate of men, and that's actually not a new thing. That's been true for many years now. And of those, so as I said, women are starting businesses at twice the rate of men in the US at the moment. And of those, 8.9 out of 10 are started by women of color. So basically, by the numbers, entrepreneur equals predominantly women of color. If you look at who's getting invested, that's clearly not reflected in those numbers. But what you also see is that the people who are doing the investing haven't changed in many decades. And so the reason that I went from founder to investor in startups to now allocator upstream, where I'm actually writing LP checks into funds, is because I realized that the only way this number is going to change, facts are not, we're not going to research our way out of the problem. We've been doing that. Bless Sheryl Sandberg, but we don't need any more studies. We already know. There's actually a woman who went in front of Congress with actuarial data stating that, for example, women over the age of 50 have something like double the chance of being successful at being startup founders. If Silicon Valley was really just in it for the money and really halfway decent at math, Silicon Valley would be just bursting at the seams with women over the age of 50 if they were just in it for the money and they were following the math. Clearly, the numbers and the rational decision-making are not at play here. And so what I decided anyway is that what's at play here is that we need to change who's writing the checks. And now that I'm investing in those investors, I get to decide.
Yeah.
And so that's my solution for it.
Yeah. Yeah. I see my husband back there. On that note, women over 50 starting a business, maybe we should do a startup? What do you think? All right, thank you so much. Any other questions? Let's get a mic back there. Thank you, guys.
I love it. You just warmed them up. People were shy at first. Thank you, Karen.
Okay, and are there any, if someone back there could let us know if there's anybody with questions online? Just give us a wave if there are. Okay.
Cool. I'll go.
Okay.
Hi, what's your name?
I'm Andy. Nice to meet you. Thanks for coming.
Thank you.
So I'm new here, and you mentioned sort of alternative investment strategies, and you literally said like writing checks as an LP. With the rise of micro funds and larger funds getting smaller, like what do you see the relationship with more of these angel networks like here and more of like, hey, hire a GP, like you invest smaller sums and sort of that more micro fund strategy that I haven't quite seen here?
I mean, I would say the next big thing is not going and has historically not come from the large corporations. They're just not wired for that. And so I think that there will always be an important role for the micro funds, for the angel networks, and for the smaller, innovative, agile startups. And yeah, you're right. Like the larger ones simply don't have the way that the funds are structured, right? It doesn't matter how much on their website it says we're founder forward, we invest in, we spend time with our founders. By the sheer numbers, if you have a $200 million fund and you have a staff of 5, you are investing in, and let's say the average check sizes are such that you have a portfolio of 100 companies, 5 people do not have time to roll the red carpet out and spend lots and lots of times with 100 companies. Many of you probably lived this. When the pandemic hit, the only people getting a phone call returned was the ones that were in that top 5% of the ones that they had decided were their favorite children, right? The other 95% didn't get a phone call returned in a crisis like the pandemic, when the pandemic hit. So everyone really felt that, right? It's portfolio theory, it's spray and pray, whatever you want to call it. And so the people that can focus and really give love and energy at a small scale in a concentrated way early on are going to continue to be the ones that build the future. I was sharing with Rebecca that Ev Williams, the co-founder of Twitter, recently reached out with his next thing that I can't share more than that on. But he didn't go to a big, to your question, VC firm. I'm sure he has plenty of those relationships. He went to friends and angels. He didn't need to, but that's what he decided to do right now. Because those are the people who will pick up the phone, who will add value, who will be mentors, who will be a sounding board. I don't know if that answers your question, but I don't see that role ever going away. I think that's what innovation needs.
Natalie Molina Nino, thank you so much for joining us.
Thank
we
you.
really appreciate your perspective. And where can we find your book? Probably just about anywhere, right?
Yes.
Yeah.
The book was published by Random House. It's called Leapfrog, The New Revolution for Women Entrepreneurs. Of course, men read it and say, Natalie, there's nothing in there that is, that wouldn't be useful for men. And so by all means, men can read it, but you know who my target audience is. It's the women who aren't getting the checks. I want them to have an unfair advantage.
Thank you so much.
Round of applause for our panelists, please. So we're going to take just a really quick break.
I
but
forgot
then come
something. Sorry, Tracy.
Yes,
I have a little
please.
gift for you.
Yes, we have a gift for
and we
you,
have to tell you
Natalie.
something about the gift because that's how women are. We have to explain the gift to give you the gift. So, yeah. Well, if
Is
I'd
it
only
underwear?
known. So one, we know that you have dogs. And two, we have a phenomenal company locally that is also women-owned. And you will see some of these shirts in the audience. It's called Rowback, and they have a little dog on them. And
I
so
love
we
it.
got you a little
This is
Rowback
amazing. I
shirt.
love
So
it.
It's Charlottesville Company.
Karen wanted to know if it's underwear, so no, it's not underwear.
You can sweat in it.
All right, so
Thank you.
grab some coffee
Lovely.
and some dessert and come back. We're going to get started toot sweet on our lightning round 4-minute pitches from these lovely founders.